Hello everyone, Suze Orman here. You have an insurance policy, you paid your premiums, and then it expires. It's a common scenario that many people face. You might think that because you were diligent in paying your premiums, you should be able to file a claim even after the policy has expired. Can you file a claim on an expired policy? Most of the time, you cannot. The expiration of a policy typically means that the coverage period has ended, and with it, your protection. An expired policy is usually just that, expired. It no longer offers the protection it once did, and any claims made after the expiration date are generally not honored. However, there are exceptions based on the type of policy you had. Different policies have different rules and stipulations that can affect whether or not you can file a claim after the policy has expired. Was it an occurrence policy or a claims-made policy? Understanding these terms is crucial. An occurrence policy covers incidents that happen during the policy period, regardless of when the claim is filed. On the other hand, a claims-made policy only covers claims made during the policy period. Think of it like a concert ticket. If your ticket was for last night's show, you can't use it tonight. The same principle applies to most insurance policies. For many insurance policies, once the coverage period ends, so does your protection. This is why it's so important to understand the terms and conditions of your policy. But what if the event happened while you were covered and you only found out later? This is where the type of policy matters. An occurrence policy might still cover you, while a claims-made policy would not. We'll explore these exceptions and break down policy types with simple examples. Understanding these nuances can make a big difference in how you handle your insurance. Knowledge is power, especially regarding your money and protection. The more you know, the better prepared you'll be to navigate the complexities of insurance. Let's get smart about insurance together. By understanding the details, you can make informed decisions that protect your financial future. It's time to take control and understand the rules that govern your financial safety net. Don't let a lack of knowledge leave you vulnerable. You work too hard for your money to leave it on the table because you didn't understand the fine print. Make sure you know what your policy covers and what it doesn't. Let's dive into the details. By the end of this, you'll have a clear understanding of how to protect yourself and your assets. Let's break this down. Insurance policies, especially for professional liability, fall into two main types: occurrence and claims made. An occurrence policy covers incidents during the policy period, regardless of when you filed a claim. If the event happened while your policy was active, you can file a claim years later. A claims-made policy requires the claim to be reported during the active policy period. If your policy expires and you report a claim afterward, it will likely be denied. Why choose a claims-made policy? Cost. They're typically cheaper initially. This lower cost comes with a trade-off in long-term protection. You're trading future security for present savings. Understanding these differences is essential for protecting your assets and future. Let's explore how these policies work in real-world scenarios. Let's focus on occurrence policies for long-term protection. The key date is when the incident happened. If your policy was active on that day, you're covered, even if you discover the issue years later. Imagine you're a contractor with an occurrence policy from 2020 to 2022. In 2021, you completed a renovation. In 2026, a problem is discovered. You can still file a claim because the issue occurred during the policy period. This protection extends beyond the policy's expiration date. It's a long-term investment in financial security. The expiration date doesn't close the door on claims for past events. Your responsibility is to prove the event happened during the policy period. If you can, your expired policy should cover the claim. Let's clarify how occurrence policies work with a real-world example, so you can see exactly why they're so important for business owners. Imagine you own a toy store, and in 2023, you purchase an occurrence-based insurance policy to protect your business from potential claims. Fast forward to 2026. A parent comes forward, claiming their child was injured by a toy they bought from your store back in 2023. Even though several years have passed, the incident itself happened during the time your occurrence policy was active. Your current insurance policy, the one you have in 2026, won't help with this claim, but your 2023 occurrence policy is still responsible for covering the incident because the injury occurred during its coverage period. So, you file a claim with the insurer who provided your 2023 policy. Even though that policy has technically expired, the insurance company must still investigate and handle the claim, since the event happened while you were covered. The key point is that coverage is tied to the time frame you paid for, not when the claim is made. This means your protection is locked in for incidents that happen during the policy period, no matter when someone files a claim. This provides real peace of mind. You can change insurers, sell your business, or even retire, knowing that your past work is still protected by the policies you had in place at the time. That's why it's absolutely crucial to keep detailed records of all your old insurance policies, even after they've expired. An expired policy might seem useless, but in reality, it could be invaluable if a claim arises years later. Having those documents on hand can save you from a lot of stress and financial risk. This is the protective logic behind occurrence policies. They're designed to safeguard your business from claims tied to your past actions, not just your present ones. The coverage doesn't simply vanish when the calendar flips to a new year. It remains in force for incidents that happened during the policy period, no matter how much time has passed. This proves that maintaining organized records and understanding your insurance coverage is a key part of any smart financial plan for business owners. Ultimately, your past work and decisions are protected by the occurrence policies you had in force at the time, giving you long-term security and confidence as your business grows and changes. Now, let's discuss claims-made policies. 2 conditions must be met. The incident must occur after the retroactive date, and the claim must be reported while the policy is active. Suppose you're a consultant with a claims-made policy in 2025. You give advice in June, but your policy expires in December. In 2026, a client sues you for that advice. You can't file a claim because the policy expired. The solution? Tail coverage, which extends the reporting period. It's crucial, but often expensive. Tail coverage buys you more time to report claims. If you plan to retire or switch policies, consider purchasing tail coverage. It's the only way to protect your past work. Let's explore a claims-made scenario. You're a graphic designer with a claims-made policy. In April 2024, you complete a project. In June, you renew your policy. In August 2025, a client faces a legal challenge due to your work. You file a claim, and because your policy is active, you're covered. But if you let your policy expire in June 2025, the claim is denied. The protection disappears when the policy ends, unless you have tail coverage. This example shows the importance of understanding your policy terms. It's the difference between having a safety net and facing financial ruin. Know your policy type and plan accordingly. A single change, letting the policy expire, has massive consequences. Tail coverage would have extended your reporting period. Let's simplify the differences between occurrence and claims-made policies. An occurrence policy covers incidents during the policy period, regardless of when you file the claim. A claims-made policy requires the claim to be reported during the active policy period. Occurrence policies offer permanent protection for a specific time. Claims-made policies require continuous coverage or tail coverage. The lower cost of claims-made policies comes with the responsibility of managing coverage. A single day without coverage can erase years of protection. The choice between these policies has profound financial implications. Occurrence policies offer peace of mind for past events. Claims-made policies require constant attention and planning. Neither is inherently bad, but understanding them is crucial. It's a gamble where you might not know you're at the table until it's too late. What about auto and life insurance? Do these rules apply? Auto and life insurance have simpler rules. Auto insurance is occurrence-based. The policy active on the accident date pays the claim. Life insurance pays out upon the insured's death if the policy is active. No need to worry about claims-made complexities for these policies. Continuous coverage is crucial for auto insurance. Life insurance requires timely premium payments. The main takeaway is the importance of continuous coverage. Never let your auto insurance lapse. Always pay your life insurance premiums on time. These policies are straightforward. Was the policy active when the event happened? It's a clear line in the sand. We've covered a lot so far, and by now you probably realize just how complex insurance policies can be. It's easy to feel overwhelmed when you're surrounded by stacks of paperwork and legal jargon. But don't worry, there's a clear way forward. If you ever find yourself needing to file a claim on a policy that's already expired, there are two crucial questions you must ask yourself before taking any action. The first question is, what type of policy did you have? This is the foundation for everything that follows. Start by digging out your old policy documents. Even if they're buried in a drawer or stored away in a box, it's worth the effort to find them. Look closely for the words occurrence or claims made. These terms are the key to understanding your rights and options. The answer you find here will determine your next steps and whether you have a valid claim to pursue. The second question is just as important. When did the incident actually happen? Pinpointing the exact date is essential. Take that date and compare it to the coverage period listed on your old policy. This step is critical to see if your situation fits within the policy's terms. If the incident falls within the period of an occurrence policy, you're in a strong position to make a claim, even if the policy itself has expired. These two questions are your power tools. They help you cut through confusion and take control of your situation. Once you have your answers, you'll know whether it's time to reach out to your old insurance company and start the claims process. If you discover you had a claims-made policy but didn't purchase tail coverage, unfortunately, your options are limited and you may not be able to file a claim. But if you had an occurrence policy, don't hesitate. Make that call. You have every right to pursue the protection you paid for. Remember, your premiums bought you coverage for incidents that happened during the policy period, no matter when you file the claim. You have a right to that coverage, and you shouldn't let uncertainty or confusion stand in your way. So, be smart, be strong, and take control of your financial protection. With the right information and a little determination, you can make the most of the coverage you worked hard to secure.